Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets those companies try to hide in plain sight. Today we're diving into a company that is busy lending money, and it sounds like they've been quite active making some sales. So what we have here is a report from Fortress Private Lending Fund. Think of them as a company that loans money, and this report is telling us about some of their recent activities, specifically a big sale of their own shares. Now, this isn't a regular stock sale that you and I can just hop into. This is often how funds like this raise money by selling shares directly to certain investors. They sold quite a few, about 1 million shares, raking in a hefty $25 million. This happened in November of 2025, though the exact number of shares was locked in on the 19th of November. The price of these shares was tied to the fund's performance, specifically its net asset value, or NAV, per S-Share on the 31st of October. They are framing this as a sale under an exemption that basically means they felt they didn't need to do all the usual registration hoops with regulators, because they were selling to what they consider sophisticated investors, or accredited investors who supposedly know what they are doing and can afford to lose their money. Speaking of net asset value, let's look at how the fund was doing financially. As of the 31st of October, their Class I shares, which are the ones they just sold, were valued at $24.89 each. This is a crucial number because it is the benchmark for their sales. Now, as of that same date, the whole fund was worth a staggering $795.5 million. And here is an interesting tidbit they share. They had about $1.1 billion in what you could call their investment portfolio. But against that, they had about $342 million in debt. So they're leveraged, which isn't unusual for a lending fund. But it is something to keep an eye on. Now, what does this mean for the investors who own these shares? Well, the fund also declared a distribution, which is basically a payout of profits. For November 2025, holders of Class I shares were set to receive about 16.59 cents per S-Share. This money was set to be paid out in late December, either as cash or reinvested back into buying more shares, which is a common strategy for funds like this to keep growing their asset base. Let's dig a bit deeper into what they actually invest in. As of the end of October, their portfolio was valued at around $1.1 billion spread across 64 different companies in 29 industries. The really interesting piece here is the kind of debt they hold. Almost all of it, 99.94% to be exact, is what they call first lien, floating rate debt. That means they are the primary lender, meaning they get paid back first if a company runs into trouble, and the interest rate adjusts with market conditions. This is generally considered a safer bet in the lending world. The median size of the companies they lend to, measured by their earnings before interest, taxes, depreciation, and amortization, was $80 million. This suggests they are lending to mid-sized companies. The average loan to value of their investments was around 41.76%, and their interest coverage ratio, meaning how easily a company can pay its interest, was 2.8 times. This indicates that, on average, the companies they lend to are generating enough profit to comfortably cover their interest payments. The average yield, or the return on their directly originated debt, was 10.53%, but the overall portfolio yield was a bit lower at 9.76%. This difference might be due to other investments or fees within the fund. They also mentioned they are continuously offering shares under similar exemptions, meaning they are always looking for investors to put money into the fund. So far in total, they've issued over 32 million shares and raised a massive $822.3 million. That number doesn't even include the shares bought through their reinvestment plan, so the actual amount of money flowing into the fund is likely even higher. So, what is the story here? Fortress Private Lending Fund is actively growing, raising capital, and deploying it into debt investments, primarily senior secured loans to mid-sized companies. They're presenting a picture of a well-managed fund with a clear investment strategy. The recent share sale of $25 million shows continued investor appetite, likely drawn by the fund's yield, which is advertised around 9.76% overall. The fact that they are prioritizing first lien debt suggests a focus on capital preservation, which is smart, especially in potentially uncertain economic times. However, we should always be cautious. While a 10.53% yield on directly originated loans sounds attractive, floating rate debt can become more expensive for borrowers if interest rates rise significantly, potentially impacting repayment. The nearly $342 million in debt outstanding also acts as a leverage amplifier, meaning both gains and losses can be magnified. Their reliance on exemptions for sales means that detailed operational information, usually provided in public filings, isn't readily available to the average investor. This lack of transparency is a double-edged sword. It allows the fund to operate with flexibility, but also means less public scrutiny. Looking ahead, their ability to maintain these yields while managing risk will be key. If the economy slows down, the performance of those mid-sized companies they lend to could be tested, and that would directly impact Fortress. The continuous offering model means they will likely keep coming back with these reports as they continue to grow. Alright, that is our deep dive into Fortress Private Lending Fund's report. What do you think about their lending strategy and their recent share sales? Does the focus on first lien debt give you confidence, or does the leverage raise concerns? Let me know your thoughts in the comments below. If you found this breakdown valuable, please give this video a thumbs up and subscribe for more corporate decoding. And definitely check out our Discord community, linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.